Currently, Wall Street is pricing a thriving company like it's already bankrupt? Welcome back to Smart Stock Sam, where we expose the market's biggest inefficiencies. Today, we're diving into why AMC might be on the verge of the most violent price correction we've seen in years. Is this the moment to buy every share possible before the explosion? Let's find out. Right now, AMC Entertainment is experiencing what I call a strategic disconnect. While the company's operational recovery is climbing higher and higher, the stock price is being dragged in the complete opposite direction. This isn't just unusual, it's a valuation anomaly that defies basic market logic. The gap between operational reality and market perception is widening so dramatically that a violent reversion to fair value could be inevitable. But how did we get here? Here's the paradox that should make every investor stop and think. AMC's market cap sits at roughly $762 million. That's the exact same valuation it had in the third quarter of 2020 when theaters were shuttered and bankruptcy was literally knocking on the door. Fast forward to today, and AMC just posted its strongest first quarter performance in 5 years. Yet the market is valuing this recovering, cash-generating business identically to a company that was on life support. Even more striking, the company's verified net property assets and cash position total over $1.7 billion, which actually exceeds the entire market value of the stock. How is this possible? Let's break down the absurdity of this situation. In 2020, operations were completely halted, margins were deeply negative, and the market sentiment was crystal clear: bankruptcy imminent. Now compare that to today. AMC has a verified asset base of $1.4 billion in property alone, positive EBITDA, and an astounding 81.2% gross margin. These aren't marginal improvements, these are fundamental transformations. Yet somehow, the market cap remains frozen at the same distressed level. It's as if the market is completely ignoring that AMC evolved from a dormant entity into a recovering powerhouse. Even if you ignore all the meme stock speculation and approach this purely from a traditional liquidation analysis, the numbers are staggering. When you combine $1.4 billion in property value with a $350 million cash position, you arrive at a total asset value of $1.75 billion. Meanwhile, the stock trades at a market cap that's less than half of that. The intraday ticker price has become completely decoupled from the fundamental floor represented by the company's own balance sheet. What could possibly justify this massive discount? This recovery didn't happen by accident. AMC executed a calculated strategic pivot from pure survival mode to offensive growth. Through aggressive debt restructuring, management manufactured the breathing space needed to pursue high-margin opportunities. They've adopted what I call the gatekeeper model, securing premium distribution deals like the Leica partnership for the film Wildwood. They're even mastering viral merchandising. The upcoming Scream 7 Ghostface popcorn bucket is a perfect example of a high-margin sentiment shifter that drives both revenue and cultural relevance. But does the hard data actually support this aggressive new strategy? The latest fiscal report from November 5th was a resounding validation. AMC brought in $1.30 billion in revenue, beating the $1.21 billion estimate. While they narrowly missed on earnings per share, their gross margin efficiency hit 81.2%, proving they've achieved robust cost control even amid challenging market conditions. The internal fundamentals are stabilizing and improving. Yet there's one massive obstacle preventing this value from being recognized by the broader market. This is where things get controversial. Roughly 70% of AMC's total trading volume is consistently routed off exchange into what are known as dark pools. When 90.1% of retail buy orders are diverted away from lit exchanges like the New York Stock Exchange, the buying pressure that should push prices higher is essentially neutralized. This creates a bizarre situation where demand doesn't translate into price discovery. Instead, it gets absorbed into invisible venues, effectively suppressing the stock price regardless of how many people are buying. But the dark pool issue is just the surface. Analysis suggests there's a synthetic liquidity loop operating in the background. By using tokenized representations of shares, certain institutions can satisfy regulatory locate requirements for short selling without actually holding the underlying equity. This creates what appears to be infinite synthetic liquidity, keeping borrow fees artificially low even when there are literally zero physical shares available to short. It's a mechanism that bypasses normal supply and demand dynamics, creating a synthetic ceiling on the stock price. When you trap a coiled spring like this for long enough, you eventually create a powder keg. And right now, the technical setup is screaming asymmetric risk. We're seeing a perfect double-bottom structure forming at the $1.35 level. Short interest is sitting at a massive 24.22% of the float. The RSI is deep in oversold territory, and most importantly, there are zero shares available to borrow for new short positions. This is a technical configuration that's heavily skewed toward a violent move upward. But what could light the fuse? AMC doesn't trade in isolation. It's part of a larger speculative ecosystem. The stock often acts as a proxy play for GameStop due to their high beta correlation within the meme basket. Strategic maneuvers by GameStop, whether it's speculation around Merger Monday or a decisive break above $32, frequently act as the primary volatility trigger for AMC. If the containment mechanisms holding the entire meme basket together suddenly break, the synthetic positions built up over months or even years could be forced into resolution, and when that happens, the price action could be explosive. There's also a macro dimension to consider, the collateral liquidation thesis. Many hedge funds use their big tech holdings as collateral to support their short positions in stocks like AMC. But what happens if we see an AI bubble pop or a significant breakdown in the S&P 500? If the value of that collateral drops sharply, it could trigger involuntary margin calls. Those margin calls would force the rapid closure of short positions to satisfy requirements, potentially setting off a chain reaction. Could a single earnings disappointment from Nvidia or Google be the spark that ignites this entire thesis? So, what does all this mean for your portfolio, and how should you approach this opportunity? The strategic framework is straightforward. The entry trigger is a confirmed break and hold above $1.50, with a strict stop loss positioned below the $1.35 floor. This gives you clearly defined risk. For short-term traders, the initial targets are $1.55, $1.60, and a gap fill at $2. But for long-term believers in the thesis, the ultimate target is a full reversion to asset value, which could take the stock beyond $10. The disconnect between a $1.35 stock price and a $1.4 billion asset base represents a rare asymmetric opportunity with a well-defined downside floor. Lastly, always do your own research before investing. This video is for educational and informational purposes only and should not be considered a financial advice. I am not a licensed financial advisor, and all investment decisions are your own responsibility. The stock market involves substantial risk, and you should never invest money you cannot afford to lose. Past performance does not guarantee future results. If you found value in today's analysis, smash that like button, subscribe for more market insights, and drop a comment letting me know what you think about the AMC's incoming mother of all short squeezes. See you in the next one.